participant numbers. So as I said, welcome to BDO's April Staying on Top of Tax webinar. This is our employers year-end special. We will be covering a range of topics. So we'll just, next slide, please. Just have a look at the speakers. So you have speakers covering employment taxes, global employer services, share plans, incentives, gender pay, employment tax, and corporate tax. So we'll move on to the agenda now on the next slide. So we'll start by setting the scene with a bit of economic context and headlines. Then we'll go on to talking about P11D and PSA reporting, as well as covering the new proposals for the mandatory payrolling of benefits. Then we'll go on to gender pay gap reporting, short-term business visitors reporting, which will look at both the expatriate tax issues, and Julia will touch on corporate tax points that you need to be aware of. We'll then move on to share plan reporting, finalising the webinar with CIS Deadlines and Changes, and then there'll be a chance at the end for you to ask any questions you might have. If during the course of the webinar you have a question, please could you put it in the Q&A? That's where we'll be picking up all of the questions during the webinar, and we will pick up as many as we have time for. I may group them into themes if we have some similar questions, so please bear with me if we do that. So next slide, please. So I'm Caroline Harwood. I head the employment taxes team nationally for BDO, and I came back from holiday last week delighted to see two things. The first was that the National Global Employer Solutions team here at BDO has been shortlisted for Employment Tax Team of the Year in the Tolley's Tax Awards this year. So we're absolutely delighted with that, and congratulations to all of the team. And secondly, the latest Business Confidence Monitor has shown that for Q1 2024, we have a significant improvement in sentiment compared to the weak, if slightly positive, confidence that we'd had in the previous quarter, as well as the average for 2023. So the index rose above its pre-pandemic average for the first time since Q1 2022. Economic prospects are brightening, and that is across all sectors. So that is extremely good news and a nice place to be setting economic context from. So next slide, please. The unemployment rate is currently 3.9% according to the latest ONS statistics for Q1. That's a small uplift from last year. It's largely unchanged from the previous quarter. So unemployment is no longer rising, which is good news, and is not rising significantly. The employment rate is 75%. That's below the estimates of a year ago and down in the latest quarter. But that means that more people may be moving into self-employment rather than necessarily unemployment based on the small increase in that latter statistic. Vacancies in the UK fell by 43,000 on the quarter, so that takes them to 908,000. That's a fall for the 20th consecutive period, but they are still above pre-coronavirus pandemic levels. So there is still a low number of unemployed people per vacancy, 1.5, so there is space in the labour market. The economically inactive make up 21.8%, which is above the estimates of a year ago and increased in the latest quarter. So that's students, those on long-term sick, and the retired. Payrolled employees were up to 30.4 million. So that's up 1.3% between January 23 and 24. The redundancy rate is 4.6 per thousand in the 3 months to January 23, which was up from 3.5 per thousand a year ago. Again, an increase, but low. So moving on to the next slide. What we're seeing in practice in terms of pay increases are annual growth in regular earnings. So that's your basic pay, etc., but it excludes discretionary or variable items such as bonuses, was 6.1%. with the average in total earnings, which includes bonuses, being up by 5.6%. Split between the private and public sector, that's slightly higher in the private sector at 6.1% and 5.9% in the public sector, but that gap has narrowed significantly compared to this time last year, and that's due to action to increase, in particular, wages in the National Health Service, as well as the impact of the increases in national minimum wage. So if we adjust that for inflation, so CPIH, that includes property costs, is 3.8%, with pay rising by 1.4% for total pay and 1.8% for regular pay in real terms. We lost 203,000 working days in January 2024 because of labour disputes, which seems like a really, really high number. But if we look back to last year, it's about a quarter of the number of days lost in December 22, which was more like 800,000. So the number of work days lost because of disputes are down significantly. Hybrid working is still a must-have, and that is particularly relevant for your short-term business visitors, as well as looking at hybrid working in the UK. So where are your employees working? Is it in the UK or abroad? And we'll be doing a webinar specifically on that issue in the next couple of months. I'll come back to that later. Employers need to be aware of the increases in national minimum wage. So those are now in force and will have represented increases around 10% or more for some age sectors for national minimum wage. So if you have a low paid workforce, are you paying them enough? Some of that cost increase will be offset by the NIC reduction coming into force in April 24, but that's an amount paid by employees rather than employers. So the employers don't benefit from it. Employees will get both an NIC reduction and an increase in national minimum wage, which is good news. Demand is higher than candidate supply, but that trend is slowing. But you are having to pay more still for those who are providing off-payroll labour. So next slide, please. What are we going to see going forward? Well, we're looking at a forthcoming general election, so it really is a bit of crystal ball gazing, but it seems likely that we may well see consultations on employment status. Now, that is pretty much guaranteed if we have a change in government, and if we don't, it also seems likely because IR35 remains a key point of everybody's compliance in terms of checking their labour supply chain. But we're seeing issues around umbrella companies, managed service companies, etc., all being focused on by HMRC. So we can expect something no matter what happens in terms of employment status. And we may well see a reform of the apprenticeship levy. So that's something to look out for. We know that payrolling benefits will become mandatory. We will see more and more people introducing payroll benefits over the next 2 years. And from April 2026, it will be a must do, not a we can do if we want to. So look at that in terms of how it's going to impact you as a business. And I know that our next speaker, Cheryl, will be touching on that in a lot more detail. So next slide, please. I'm not going to read through this slide or the next slide. It's a series of dates. You will be provided with a copy of the slides at the end of this webinar. So this is for your reference. So these are the key dates going forward for employment tax compliance. Next slide, please. Going on through the rest of the year to the year end, and on to the next slide, please. So I'm going to ask you to do a quick poll, and here are the polling questions. So you will see a poll come up on your screen. The first question is, what are your main challenges with year-end reporting? So you may choose lack of time or resources, lack of budget to invest in the right systems and tools, data collection, preparing and calculating, finalising the submission of reports, understanding how to complete what is required, or others. So please, could you just click what you feel your main challenges are with year-end reporting? And you can choose more than one if you wish to. So I'll just give you a couple of minutes to complete that question. Are we ready for the answers yet, Seska? Lovely, thank you. Now, unsurprisingly, 43% of you are citing lack of time and resources as a challenge. We're seeing more and more compliance requirements putting administrative burdens on businesses, so that doesn't surprise me at all. And equally, 43% noting data collection being a key challenge, which undoubtedly is connected to that. Preparing and calculating and understanding how to complete what is required also rank highly. Hopefully we will help you with understanding how to complete what is required over the next few sections of this webinar. And if you have any questions, please do contact any of the speakers. Next question, please. So how would you characterize your internal processes in relation to employer year-end reporting? Now, this is a single choice, only one answer, please. So do you have robust processes, and are you satisfied that they're completely fit for purpose? Or do you have reasonable processes that are fit for purpose currently? Are your processes hard to navigate? Do you have any concerns that there might be some gaps? Or do you need to review your processes? So if you could choose one of those. So we're looking at gold standard, fit for purpose, needs to get better, needs to be looked at completely, really, in terms of our answers. And please feel free to answer. These are anonymous. We won't be publishing anybody, naming or shaming or publishing anybody's details in response to these questions. So feel free to answer if you're not completely comfortable with your processes at the moment. So the answers are, typically we have reasonable processes that are fit for purpose currently, which is good news. So that is excellent. But what it does highlight is, I think we all know that we don't know what's going to happen next in terms of employer compliance. And therefore, it's important to remain constantly aware of the changes in our reporting requirements to make sure that we can keep up to speed with what is needed. So thank you for that, Zeska. If you could close the poll, and I'm going to hand on now to my colleague Cheryl Thompson, who's going to talk to you about P11D PSA reporting and other issues related to benefits in kind. Over to you, Cheryl.
Thank you, Caroline, for that introduction, and good morning to all. So today I'm going to be covering Form P11Ds, payrolling of benefits, and PAYE settlement agreements. Next slide, please, Zeska. So looking at Form P11Ds and the Employer Declaration P11D, any employer who has employees who are provided with taxable benefits will need to complete the annual filing to HMRC on a Form P11D, unless that benefit is formally payrolled or is reported under a PAYE settlement agreement. So a typical example of what we would see as a benefit being reported on a Form P11D is that such as private medical or dental insurance. But there are many other benefits that also may need to be considered to be reported. The Forms P11D and the P11DB, which is the employer return, must be filed electronically with HMRC, as paper filings were abolished from last tax year. HMRC will accept the electronic submission or substitute forms, such as those produced by the BDO P11D software. The statutory deadline for the filing remains the 6th of July, following the end of the tax year, and the associated employer Class 1A is due by the 19th of July for cheque payments or the 22nd for any online payments. Next slide, please. So looking at payrolling of benefits and what is the current position, and it is important to note here that if there is a formal payrolling arrangement for benefits that has been agreed with HMRC, an employee Form P11D does not need to be produced for that employee. However, the employer Class 1A national insurance must still continue to be collected and reported on an employer P11DB for the taxable value of the payroll benefits. So to payroll a benefit, and currently this cannot be for accommodation or beneficial loans, that agreement must have been with HMRC for the current tax year, being 24-25, by the 5th of April. Now, as an employer, you would have needed to have done this directly with HMRC, as your payroll or your tax agent cannot do this for you on your behalf. Next slide, please. So what is changing? As Caroline mentioned, HMRC issued guidance on the 16th of January and have confirmed, and as was expected, that from April 2026, pay rating for benefits is now going to be a mandatory requirement for all employers and will apply to all employees, be they paid monthly, weekly, or on variable pay periods. So while the good news is that Form P11Ds will no longer be required, and therefore employers will welcome the admin that is required each year to prepare and submit these forms will go away. And helpfully, the Revenue have now allowed a 2-year transition period for you to look at your payroll processes and systems to implement this. There's several important areas that you may need to consider. that could impact the reporting and your current processes. So we've prepared a summary on the right-hand side, which sets out some of the main areas that you may need to consider to ensure that your reporting for RTI payroll reporting is correct. So just to touch on a couple of examples, looking at your joiners and leavers, for RTI payrolling reporting, the apportionments set to their start or leave dates must be correct. Also, you may need to consider where you have an insurance premium and that is renewed midway through the tax year. That change will need to be fed through to your payroll team in real time. For RTI reporting, think about what your current payroll processes look like and who may be responsible to oversee these changes. As it is with all things relating to payroll, it is important to get the reporting correct, as potentially PAYE penalties would apply. Next slide, please. So if you are sat there thinking, how do we as an employer plan for this? You are not alone. So to help you think about the planning that may be needed, we have listed for you some key takeaways to consider in advance of April 2026. So one of the things you may need to be thinking about is how will your payroll, your HR teams, your finance teams need to collaborate to ensure that your data is collected and from all data points is clearly understood and put in place. If you think about various data points such as PMR, company cars, relocation benefits, accommodation benefits, there are various data points that are involved. And also, are the teams going to be sufficiently experienced to carry out those benefit calculations to ensure that these are correct for RTI payroll reporting, be that on a monthly or a weekly basis? Do they potentially need some specialized training to do this, or do you potentially need some specialist support from an advisor? You'll also need to consider the comms that need to go out to your employees, as they will see an impact on their net pay. So it is important to consider that they're informed about these changes so that there's no unexpected surprises for them from April 2026. So as you can see, there's a lot to consider when we are looking at payrolling of benefits from April 2026. And what we are seeing, that the complexity to do this and to put this all in place, even though 2 years does sound like a long way down the line, must not be underestimated at all. Next slide, please. So turning to PAYE settlement agreements. So if you as an employer provide any ad hoc staff entertainment events, for example, your employees go out to eat at a local eatery, you have an annual staff event and the conditions for the annual function event does not apply, or you are providing recognition awards, staff gifts, be that to employees and directors, then a PSA is something you may wish to consider putting in place with HMRC. The PSA is a voluntary agreement, and as an employer, you have the option to enter into this contract with HMRC. Now, there is a deadline. It has to be done by the 5th of July following the end of the tax year, and that is for all new contracts with HMRC, or if you have an existing contract, if a variation request is needed. HMRC do not accept retrospective applications with regards to PSAs. So one of the key benefits and the difference between where you are payrolling a benefit for an employee or reporting on a Form P11D and a PSA is the PSA is a reporting mechanism that will allow you as an employer to settle the income tax, which is on a grossed up basis, and the associated Class 1B national insurance on behalf of the employee for a reportable benefit that potentially is something that is seen to be a reward in nature. Now, while there isn't a statutory deadline to file the PSA return to HMRC, the payment date is statutory and therefore best practice to get the return to HMRC by this date, and that is the 22nd of October following the end of the tax year for online payments, or by the 19th of October for any cheque payments. Next slide, please. So finally, what we have done here is we have provided you with a decision PSA flowchart. Now, I'm not going to go through this in any manner of detail. There's quite a lot of information in there for you to consider. And in the essence of time, this is going to be available in the slide pack following the webinar. And it's something there for you to work through and to consider whether a PSA would be appropriate for your business. Next slide, please. So we now have some polling questions for you. Seska, if you can pull those up. Just to talk through and to have a look to see which software does your organization currently use for P11D processing and submission. So we've given you quite a few examples there, so please do choose one that is relevant for your business. Seska, can we show the results? There you go. Thank you very much, everybody, for answering those questions and for your time today. What I'm going to do is I'm now going to hand over to Andrea, who's going to cover gender pay gap reporting. Thank you.
Thank you very much, Cheryl, and good morning to everyone. I'm aware that we have a very packed agenda this morning and a lot of content to get through. So I'm going to run through the gender pay gap reporting requirements quite quickly with an overview of the key dates and who it applies to. So for employers that are caught by the regulations, you will have just completed the reporting for the 2023 snapshot date. Now is a good time to take stock and think about organising and collating data in readiness for the next reporting cycle in April 2025. Can we have the next slide, please, Cheska? So for employers who are caught by the regulations, these will have been in place for 7 years now following their introduction in 2017. And reportable gender pay gap figures are calculated by reference to what is called a snapshot date, which for private companies, private sector employers is the 5th of April each year, which is then reported the following 4th of April. And there are slightly earlier deadlines for those public sector employers. So whilst the hourly pay gap metrics look at the pay period during which the snapshot date falls, which will typically be the April 2024 payroll month, the bonus pay gap figures look back 12 months from each 5th of April. So for the next reporting cycle that we're looking at from April 2024, we will look back to the 6th of April 2023 for those bonus pay gap figures. So next slide, please. So the regulations require a private sector employer with 250 or more employees to publicly report a range of gender pay gap information each year. So for corporate groups, this can be a little more involved, and that will depend very much on the group structure and the employee populations within that group. It's worth noting here that the reporting requirement is a per entity requirement. So groups do not report their gender pay gap on a consolidated basis. There are 6 metrics which are reportable on the government's website. So we have mean and median hourly pay gap figures, mean and median bonus pay gap figures, the ratio of men and women to each pay quartile, and the proportion of men and women receiving a bonus. And it's probably worth noting here that probably half of the clients that we work with are businesses that don't yet have a mandatory reporting obligation, so would be below that 250 employee threshold. So these are businesses who might have different reasons for completing the figures voluntarily. It might be because they know that they're shortly going to tip over the 250 employee threshold fairly soon, or perhaps because they've made internal DE&I commitments to report and track this information. Businesses may also be aware that there have been calls since the introduction of the regulations to expand the reporting to companies with a much smaller employee population. So again, some companies will want to get ahead of the curve, start preparing their gender pay gap figures in expectation of this change. Next slide, please, Jessica. So you might ask, isn't it just fairly straightforward to work out everyone's hourly pay and then look at the averages? Well, the answer to that is no. There are quite specific rules around which pay elements and which employees are both included and excluded in each of the hourly pay and bonus pay calculations. And these can be quite complex and they can involve different populations of employees. So there are definitely a few areas where the application of the regulations can be a little more complex. And in our experience, there are a few areas that quite often trip employers up. So what we continue to see in practice is employers not using the correct pay periods or the correct employee populations to calculate the hourly pay gap and the bonus pay gap figures. Tricky pay elements or particularly complex payroll, or failing to identify pay elements to include or exclude correctly can also impact the end pay gap figures. And this can have a significant impact for those employers who are at the smaller reporting end, having only just exceeded that 250 threshold. With a smaller population, it means that any slight errors are much more obvious than for a company that has 10,000 employees, for example. And then equity is also an area where the regulations provide very little guidance. And so it does mean that there needs to be a consistent approach year on year to ensure that as an employer, you are treating the equity bonus element in the correct way and the same way year on year. So next slide, please. So how do you report your gender pay gap in practice? So for those employers that are new to this reporting regime, the government website includes a portal to upload those 6 reportable metrics that need to be reported. And it's a fairly straightforward process. They have to be signed off by a director or equivalent, and the information also has to appear on the employer's external website and has to remain there for 3 years once published. And then a narrative to sit alongside the gender pay gap figures is not mandatory and is actually voluntary. But this is quite often overlooked. And because it's voluntary, it can be a very useful tool, however, because employers are able to use this to explain why a gender pay gap exists and what the business plans to do in the future to reduce any gap. And there's no prescribed format to what this narrative should include. So generally, it can be used to explain the gender pay gap. For example, this might be influenced by the type of industry that the business operates in, or a particular timing of, say, bonus elements that might artificially inflate the hourly pay gap figures. And so the narrative can be used to give some context to that. Equally, if an employer is making good progress in reducing the gap, then the narrative can be used to highlight that good news story. So ensuring that thought is given to what's included in the narrative is very worthwhile, and it can be a really valuable tool. So what happens if you don't report your gender pay gap and you have a mandatory obligation to do so? Well, there are currently no financial sanctions. So the government have typically seen this as a light touch approach to enforcement as securing an effective compliance with the regulations. Whilst the Equality and Human Rights Commission has the ability to take enforcement action, they have never, in the 7 years that the regulations have been in place, used that ability. And it's seen that the sort of naming and shaming is enough to secure compliance. So for businesses, that means that the main risk is reputational. So that is being named on the government website as a non-compliant employer. And obviously stakeholders, and this can include investors, prospective employees, and other interested parties, can therefore view on the website a business's compliance and also its current pay gap. And so may view a non-compliant company as less attractive than an organisation that's fully complying with its duty to report. And there are plenty of statistics published also as to what proportion of particularly female job applicants now that specifically will look at a company's gender pay figures when applying for a new position. So next slide, please. So one question I'm asked very regularly is how I can help companies with their reporting. And the short answer here is any way that a business really needs some support. So this can vary from taking on the main project, looking at the company's raw payroll, HR and reward data and preparing those calculations, through to checking figures that may have been prepared in-house, where an independent third-party verification of those figures is wanted by the board. We also work with businesses to carry out workshops that might focus on specific key areas of difficulty, and then a deeper analysis for some businesses who are keen to understand where the pay gap lies and want to look at the figures on a consolidated group-wide basis. So there's lots of areas that we can help, including ethnicity reporting, which, whilst it remains voluntary at the moment, and the government announced in 2022 it didn't have an intention to make mandatory, a lot of businesses do want to voluntarily complete their ethnicity figures as well as their gender pay gap figures to sit alongside those. So do take a look at the links that will be sent around in the slide pack after the webinar, and hopefully you'll find all of this of interest. And now I'm going to hand over to Stuart, who will talk about short-term business visitor reporting.
Thanks, Andrea. So in the next few minutes, I'm going to cover short-term business visitor reporting in the UK in light of the upcoming deadline for report submission of the 31st of May. Can I have the next slide, please? Thanks. So in the webinar last year, we focused in more detail on specific rules regarding short-term business visitors. But for today, I wanted to bring the topic back to basic concepts that we look at when assessing whether a business could report. So in essence, there are three fundamental questions that dictate whether a business could look to get a short-term business visitor agreement with HMRC. I've shown those on the slide and briefly mention each one now. So does your UK company have a parent, subsidiaries, or associated companies which are resident overseas? Does that UK company receive visitors from its overseas parent, subsidiaries, or associated companies? And are the home countries of those visitors who are coming to the UK countries with which the UK has comprehensive double tax treaties? So if the answer is yes to those questions, then you may wish to consider applying to HMRC for a short-term business visitor agreement. The question then becomes, why would you apply for a short-term business visitor agreement and what does it do? So the UK PAYE regulations are such that employers are obligated to operate payroll for any individual working in the UK for the benefit of a UK company. There's no de minimis limit on the number of days an individual needs to be working in the UK, so a PAYE obligation could apply from working a single day here. So if the visitor is from a country with which the UK has a comprehensive double taxation agreement, and they meet the criteria of the employment income article such that they're only really to be taxed in their home country, then they'd almost certainly not have a UK tax liability. And therefore, if PAYE was operated, it would then need to be reclaimed. So the STBV agreement was introduced to relax the PAYE obligation and to counter that issue. And it allows employers to disregard the obligation to operate PAYE in certain circumstances, on the understanding that they ensure robust practices are put in place to track visitors and make annual reports to HMRC based on the amount of time an individual spends in the UK. As mentioned previously, the annual report has to be made by the 31st of May, following the end of the tax year. And as such, we're currently in the process of preparing reports for visitors to the UK in the tax year ended 5th of April 2024. Now, it's not an obligation to enter into an STBV agreement with HMRC. But if you do have eligible visitors and no agreement is in place, then the only remaining option is to operate payroll on all individuals working in the UK. So I've left a question on the slide there, sorry, which is, what if my visitors do not qualify for STBV reporting? Well, there are a few reasons why a visitor may not meet the criteria. The most obvious is that they're coming from a country with which the UK doesn't have a relevant double taxation agreement. They're a statutory director of a UK company and performing board duties whilst in the UK. Or maybe they have a UK contract of employment and they're actually not economically employed by a non-resident employer. In some scenarios where individuals aren't eligible to be included on an STBV agreement, there may be another option to consider with regards to the payroll obligation, and that's the annual PAYE scheme. I'm not intending to cover that today because of lack of time, but if you do feel that you have visitors that may be in this category and you want more information, then please do feel free to reach out to me separately. So how do I track my visitors? So once it's determined that the business has visitors, that need to be tracked, the question then becomes one of methodology that can be used to track them. Now, there's no right or wrong answer to this question. The expectation is that a business will use the resources available to them in order to ensure that visits to the UK are identified and reported. This may include accessing visitor logs at office locations, reviews of expense reporting, or requesting staff that are visiting the UK to report those visits to a central point. There are some technology solutions available that can be implemented to assist a business with traveller tracking. It's usually considered for businesses with larger numbers of travellers, but not exclusively. Again, we're not covering traveller tracking technology today, but if you do feel this is something that would be of interest, then do reach out to me separately. So finally, to wrap up, I wanted to leave you with a few tips in relation to the SDBV reporting season itself. And the first of those is to start early. So the earlier polling question suggests that the data collection is an issue. And actually, my point about starting early is that the data collation of business visits to the UK can take longer than you expect. And there also may be queries about the eligibility of certain visitors to the UK. Secondly, consider the quality of the data. So how confident can you be that the data sources available do pick up all visits to the UK? Remember to review the origin country of the visitors closely. So while the UK does have a wide network of double taxation agreements, there are some gaps. Beware of branch structures and recharges. So the SDBV agreement does not cover non-resident employees employed by a foreign branch of a UK company. And you also need to take care if costs are recharged to a UK company, as this may disqualify the concession. Final point is that it's important to understand the purpose of the visits to the UK. So the agreement's designed for individuals that travel to the UK and work for the benefit of a UK company. As such, depending on the activity undertaken by the visitors, not all visitors will necessarily need to be reported. And this point regarding the purpose of visits can have wider tax implications. And I'd now like to pass you over to my colleague, Julia, who will take you through these.
Thank you, Stuart. Yes, we thought we'd use the opportunity of the short-term business visitor reporting to note that this is a very good time and opportunity to perform a permanent establishment or UK taxable presence risk assessment from a corporation tax perspective. So the real question here is, does the presence of the short-term business visitors and the activities that they're carrying out in the UK create a taxable presence of the overseas employing entity in the UK? And as I'm sure you're all aware, there are two main triggers that could cause this. The first could be if the STBV creates a fixed place of business permanent establishment in the UK. And that is because there might be, say, a premises and the employee is occupying those premises with a certain degree of permanence. And then the second is if the STBV is habitually exercising authority to do business or conclude contracts in the name of the overseas entity in the UK. Next slide, please. This slide gives you a couple of red flags, so things that you can particularly look out for. So if you're aware that the short-term business visitor is making sales to customers and regularly executing contracts, that would be a very clear indication. It's worth also mentioning that tax authorities are very focused on globally mobile workers. HMRC has recently produced some very useful guidance that includes highlighting factors that may increase UK permanent establishment risk for employees of overseas businesses. And that includes regular and repeated visitors. It includes continuity of overseas company presence in the UK through a series of separate individual visits on a project. And it includes UK employees seconded to overseas entities performing activities in the UK. Employees working from a home office can also cause issues. And key questions there are, what are the activities performed in the UK? What is the period of UK working? Is it simply intermittent and incidental, or is it sufficient to generate a fixed place of business? And of course, what are the activities that the employee is performing in the UK? Next slide, please. And if as a result of this review that you identify that a permanent establishment does exist, or if there is a high risk of a permanent establishment existing, an exercise may then be required to determine how much of the profit of the non-resident company is attributable to the PE. And there will be compliance obligations, including registration and ongoing filing. We regularly help clients with these permanent establishment risk assessments, and that is whether they're driven by short-term business visitor reporting results or actually any other indicator that a risk assessment would be required. So we will perform a risk assessment to determine whether a permanent establishment might exist, and if it does exist, we can advise on compliance obligations. If there's uncertainty, we can also advise on mitigating activities to make sure that the matter is clearer. Final slide, please. And given that this is a webinar focused on employment reporting dates, we thought we'd better include some corporation tax compliance dates as well. These are often very dependent on your company year end, but we'll include those in the slide pack for completion. And then this concludes my session, and we'll now be handing over to Victoria, who's talking on share plans.
Perfect. Thank you very much, Julia. So I am covering the reporting with many names. So share plan reporting, employment related securities filing, Form 42 if you were filing paper returns back in 2013, and the other annual return that HMRC most recently uses. Next slide, please. So I've used the term share plan reporting. However, please note the filing obligation is much broader than this. So if you have a share plan in place, you will absolutely need to do filing with HMRC. However, you could have employees directly acquiring shares. You could have shareholder to employee transactions. You could have the issue of loan notes. A lot of transactions will actually potentially be reportable. So the deadline for filing is the 6th of July. And once you have made a reporting requirement to HMRC, it starts the process of an annual reporting requirement. Even if there's nothing to report, even if there's no tax due, the reporting requirement remains until that plan is closed with HMRC. So if you've got any transactions going on and you think nothing's going to happen for a few years, it might be worth considering closing that reporting requirement down. So next slide, please. So I've included here some common reporting misconceptions, and I've mentioned a few. One that falls in line with kind of the STBVs and what Stuart was saying is around if you're receiving awards or shares in an overseas parent. So if it's a UK employee or director, it does not matter where that share or option sits. So if it's a share in a top company, you absolutely still have a reporting requirement in the UK. International mobile employees, again, cause problems on the reporting, particularly where that tracking piece sometimes falls out of line. So in effect, if an employee started in the UK and then left, you still have that trailing obligation and reporting requirement. Or if an employee has come into the UK, you may then start a reporting requirement for them. So it's useful to bear that in mind. Next slide, please. So what happens if you miss the deadline? So financially, there is limited financial risks. So you get an initial £100 penalty if you're late, and it goes up every 3 months. There is potentially an up to £5,000 for an inaccurate return submitted. However, I have not seen any of these applied yet. The bigger risk is around additional attention from HMRC. Also, if you're going through a due diligence and sales process, this is one area that is always picked up on. And there is also the risk to the beneficial tax treatment of any UK approved share plans. So they are the bigger risks rather than the financial risk. Next slide, please. When completing the annual returns, it's a good idea to take a step back and think about the bigger picture. What are the opportunities that the company could take? And is there anything else you need to consider from a risk perspective? So key questions: does the company have an obligation to operate payroll, and has anything changed? So if the company has gone through an IPO process, sales process, it may have triggered a payroll obligation where none existed previously. Is the company looking at the corporation tax deduction that's being claimed? And then you've got the complexities around, is a share plan settled in terms of a sell to cover mechanism or a net settled mechanism? And there is different corporation tax deductions and also reporting requirements for two different methods. I've mentioned the international mobile employee piece, but again, when they come into play, it does introduce trailing liabilities and makes the reporting a little bit more complex. And also, if you are operating internationally, think about, you've got the UK reporting, but you've got a number of other jurisdictions that require reporting. Often at this time, you can pick up, like I said, those opportunities to improve the share plan, but you can also pick up any errors and get them corrected quickly. Next slide, please. Last year, HMRC updated the other annual return. So the other annual return is anything that's not a UK approved share plan. This created much more mandatory fields. So the PAYE references, national insurance numbers. We have seen an uptick in questions from HMRC over the last year. So this has come to us in the form of employment-related securities or ERS-specific compliance checks. We've had PAYE compliance checks with more of a focus on share plans, and also we've had more questions in relation to the corporation tax deductions, in particular that difference between our companies selling to cover the tax due on exercise or whether or not the options are being net settled. This is a whole other webinar, and again, we can be contacted directly for any follow-up questions. However, in effect, the big picture is that HMRC are collecting more data and they can cross-check this information. So now is the best time to check that your reporting is accurate and that everything is aligned. Very brief overview, and I'm going to pass you across to Alison with an update on CIS, and we'll pick up questions at the end.
Thank you, Victoria. Good morning, all. Could I have the next slide, please? Thank you very much. I'm just going to give a brief overview about deadlines and some changes within CIS. There are no annual returns for the construction industry scheme. Everybody reports monthly whatever they've paid to their subcontractors who they've verified from the 6th of one month to the 5th of the following month. And that monthly return has to be submitted by the 19th of the month. So you've got 14 days after the return has to be submitted. Payments of deductions that have been made, if any, must be paid to HMRC by the 22nd of each month, the same as RTI. If it's late, then interest will accrue. Payment and deduction statements must be supplied to subcontractors suffering deductions by the same date of the 22nd. And with CIS, whether you get your returns late or your payment and deduction statements provided late, HMRC can charge you penalties. So changes that have happened from the 6th of April this year, HMRC have simplified an area that has caused multiple problems in the past in relation to capital contributions made by a landlord to a tenant for what is normally fit-out works. It has been recognised for many years that this causes problems. Certain criteria has to now be met. It has been simplified from what was in place, and that basically stipulates that a payment is made by the landlord to the tenant for construction operations, and it is the fact that it is a contract for construction operations that brings it into the scope of the scheme. But it has to be under a contract which is normally dictated to in the lease. The tenant who occupies that building for their own business must then either do the works themselves or contract with a third party. So those are the criteria. We just have to watch going forward how these will be applied by HMRC. Other changes are if a subcontractor has gross payment status, so no deduction is suffered, or is applying for it, then HMRC will look at compliance failures across other taxes such as PAYE, CIS, corporation tax, and for the first time ever, from the 6th of April, that now includes VAT compliance. It's quite draconian. You can have gross payment status refused or cancelled if, in fact, you have made more than 3, for example, RTI returns late by less than 14 days. It only takes 1 return to be submitted late, more than 28 days, to allow HMRC to actually decide to not grant or remove your gross payment status. So compliance is key across all taxes, and that now also includes VAT. Next slide, please. Just really to follow up, last few minutes, appreciate time's ticking away. CIS can be very complicated. It's a tax that's not always well understood, or even people are aware of it. If you have groups of companies that are all doing construction services and intergroup transfers of money or even paper exercises on accounts, then if there is an obligation for company A to provide CIS services to company B, then that is a CIS contract. Company A is a contractor and company B is a subcontractor. Everybody needs to be registered, and all of these payments need to be reported. Common issue with our larger groups. Entities based overseas also making or receiving payments for works that are undertaken in the UK are also obliged to register, and this is another large failing. Another area that our clients have problems with is the difference between a mainstream contractor is usually a developer or an entity holding property as stock. If they do construction works, even if it's repairs and maintenance, they are obliged to operate CIS from the outset. There's no de minimis spend before they have to register. Whereas deemed contractors, who are businesses trading, that investment companies that don't actually do construction as their main trade, they will have an obligation that when they spend more than £3 million in any 12-month rolling period, they will have to register for CIS. So tracking that CIS spend is often overlooked, and a failure to report and register often occurs. The scope of the scheme can also be really, really complicated. Building service systems is one that provides a lot of consternation with our clients. When you install one, such as air conditioning, lighting, etc., then it's caught. But if you repair it, it's not necessarily caught. Therefore, it's key to understand what scope you're undertaking and whether those services actually fall within CIS or not. So if you get it wrong, then HMRC will charge you penalties for every single return that was late in month 1, month 2, month 6, and month 12. But what is even worse is if you've paid entities that do not hold gross payment status, it leaves the contractor liable to the deductions they did not make. And it is a complicated area of getting relief against those deductions at risk. So I'm going to call it a day there. Conscious of time, I'm going to pass back to Caroline, I assume.
Thank you very much. Alice, let me just try and convince my video to start again. There we go. Okay, so we are a little bit short of time. Firstly, huge thanks to all of the speakers. I'm going to start by posing the questions that were asked anonymously, because we may, if we need to, cover the other questions personally, we'll email those who've posed other questions that we don't have time to answer. So I will start with the anonymous questions. So the first one is one for Cheryl. Do I need a PSA if the benefits, e.g. staff entertainment, are always under the limit, i.e. it would be a nil return?
That's a tricky one, Caroline, because there is specifically no limit for staff entertainment. You need to consider quite a few different areas. So you need to consider trivial benefits exemption, and you also need to consider how that expense is being paid. So is it a reimbursed expense, or is it being paid directly for the company? So it's not that straightforward to say it will be a nil return, but we can provide more information if that person would like to get in touch with us separately.
Yeah, thank you very much, Cheryl. So yes, I'd urge you to get in touch with Cheryl because it isn't a yes or no answer, I'm afraid.
Correct.
One for Andrea here on gender pay reporting. Andrea, the Republic of Ireland and the UK have legislative requirements for GPG reporting. Is there scope for any other countries to make it legislative in the next few years?
Thanks, Caroline. Yes, there will be gender pay gap reporting across the whole of the EU. So the EU's Pay Transparency Directive came into force last year in 2023, and this requires all of the EU member states to transpose the directive into local law and incorporate their own gender pay reporting requirements by June 2026. We already have some gender pay gap reporting across Europe already. However, it's quite variable, and it's not always aligned to the UK in terms of either the thresholds or the dates. So, for example, some countries have got lower thresholds of 50 employees, such as France and Italy. Germany, for example, has a higher threshold, but you also have to go further in terms of producing an action plan. So I think there's going to be a lot of movement in this area over the next few years, and probably lots of different dates. So it could be quite a headache for employers who've got lots of employees globally, particularly over Europe, where they've got to do these reports.
That's really helpful. So one to watch, Andrea. And while we've got you, could you explain how the 250 employee threshold in the UK is measured? Is it per group company or as a group?
It's per group company. So if you've got a company that's got 4 subsidiaries, 2 of which have got 100 employees and 2 of which have got 300 employees, those 2 subsidiary companies with 300 employees each have an individual reporting obligation. So it's per entity. You don't have to do it on a consolidated basis, just each subsidiary company.
Thank you. That is very helpful. So the next one I'm actually going to pose to myself, because that is only fair. And the question is, does reporting for termination payments still exist? And if yes, some comments would be great. I'm afraid the answer to that one actually is no. So with regard to leavers, employers are not required to report leavers separately to HMRC. Your date of leaving, the employee's date of leaving, is included on the full payment submission under RTI. So the employer continues to issue parts 1A and 2 of the P45 to the employee, but does not need to send part 1 of the form P45 to HMRC. If payments are made to the employee after they've left, then the employer is required to give the employee a letter or an email showing the date of the payment, the gross amount, and the amount of PAYE and NIC has been deducted. If the termination payment has non-cash benefit elements and it exceeds £30,000, then the employer should inform HMRC by the 6th of July following the year end in which the termination occurred. And that report goes to PT operations in the northeast of England. So any more details on that one, please do let us know. We're running over slightly, but we still have a lot of participants on the line. So I'm going to keep going for a little bit longer, if that's okay. Stuart, one for you. Do we have to submit anything for STBV if there wasn't anyone overstaying more than 60 days per financial year?
Sorry, so yeah, the STBV agreement is such that what we're looking at is there's a number of different thresholds, and actually the lowest one is 30 days, not 60. So it is possible. So I'll pick that up. If the person wants to give me a note by email, then I'll pick that up with them.
That's great. And can you give us the definition of economically employed for STBV purposes?
Yeah, so that's not a particularly easy one to cover right now. So, because it's going to take us through quite a long period to answer it. So I was going to go back to Barvinder on that one separately, if I may.
Excellent. No, I would think that's a great idea. We do have one other question on STBV while you're there. Do we have to report if there is nothing to report? So is there such a thing as a nil report for STBV purposes?
No, it doesn't have to be. Some companies, if they have visitors, if you have an agreement in place and all of your visitors qualify and are under 30 days, then technically you don't have to submit a report because that would be considered a nil submission. However, because of due diligence checks and things like that, some companies choose to.
Thank you, Stuart. That's very helpful. Excellent. I'm going to move on to Vicky now. Vicky, how should a repricing of stock options previously granted at a different exercise price be reflected in the ERS reporting?
Very good question. So the devil always with share plans is in the detail. Repricing, it could have been completed a number of different ways. So it could have been that the option was, say, cancelled and reissued, or the exercise price was changed, and depending on the underlying shares in the company, there may or may not be other tax implications. So again, that question was submitted with a name, so I will follow up directly.
Brilliant. Thank you, Victoria. Cheryl, quick one for you. P11Ds, are nil returns required?
Potentially. It depends if somebody's doing an informal payrolling arrangement, then nil P11Ds would still be reported to HMRC. If the question posed is around nil P11DB, so the employer return, that would depend on whether the revenue is expecting something to be filed. So if they've sent out a notification at the beginning of the year, then you would still need to file a nil P11DB with HMRC. That's a short answer.
Thank you. And I think we have time for just one more. So still with you, Cheryl. In the adoption year, payrolling will start on a monthly basis for April. Does that mean that we end the benefit in kind on the 31st of March for the previous year for the purposes of the P11D?
Yeah, it's funny that the person's mentioned in the benefit, because the benefit won't be ending. You would need to, for payrolling of benefits, then look at reporting that benefit over the next 12 months, so through payroll. So it won't particularly end, but you would still need to file a P11D for the previous tax year if you haven't formally payrolled with HMRC for that tax year.
Thank you very much, Cheryl. And for any other questions, we will be getting back to everybody individually. Zeska, if you could just move on to the next slide quickly. Thank you very much. So we have some upcoming tax events that I would just like to mention. We have Pillar 2, which is part 4 of our Pillar 2 webinar series, where we'll be doing a deeper dive into compliance and reporting to enable affected organisations to prepare and respond effectively. Then our next On Top of Tax webinar will provide information on compliance dates, relevant tax updates, and some horizon scanning. That will be on the 22nd of May. The next day, on the 23rd of May, one for attendees here is location, where are your workers working from, which will provide an insight and perspective on why businesses are embracing a truly global workforce and the opportunities and challenges this presents. Then we have our Tax in Industry Forum, which will take place throughout June. This is a personal event forum to discuss the latest tax issues, giving tax professionals who work in industry the opportunity to share their thoughts and experiences with other peers. These are in-person breakfast roundtables, providing another good way to keep on top of tax. And finally, on the 20th of June, we have the Building Supply Chain Resilience webinar, which is our first webinar in our Supply Chain Resilience series, focusing on the EU's Carbon Border Adjustment Mechanism and its impact on UK businesses and supply chains. Next slide, please, Jessica. So please sign up to our monthly newsletter and join our On Top of Tax LinkedIn group. There are some links there for you to click when you get the hard copy of these slides by email. And have a look at the BDO store for information on our e-learning of the month, which is corporate criminal offences. Do your team know how to prevent them happening? Very, very important information there. So I think that is it. Thank you very much, everyone, for attending. Thank you to everyone who has persevered to the end. That is great. And thank you to our speakers. We look forward to seeing you at the next event. Thank you. Goodbye.